You have both myself, Brent Simpson, and the co-founder Leon Noble with you. And today we're going to be talking about the economy and some of the numbers that recently came out and why it is important for you to stick around because this information might be a little bit shocking. All right, for everybody who's thinking, okay, just give it to me. Just wait. I need to do some housekeeping. Leon's going to tell you why we chose this topic, and we need you to share this. If you have not recently subscribed to our podcast and you're a new listener, please take the time to subscribe. You can find these if you want to watch the full length video and you're listening to our podcast. You can search Investing Education Academy on YouTube and subscribe to our channel on YouTube. All right, Leon, you can tell me why we chose that topic, and I'll do a little bit of housekeeping.
Yep, and just to add to what Brent said, also for the audio portion, if you wanted to listen audio, easy way to find it is at IEApodcast.com. Is that podcast with an S, Brent?
Singular.
Yeah, IEApodcast.com. So you can find the audio's there. Okay, so the topic today is essentially the consumer, and that consumer being all of us, right? Like people that consume in this country that actually spend money. And the reason this is important is because so taking a step back, Brent and I always say the stock market is not the economy and the economy is not the stock market. However, the number one influence on the stock market is the economy. There are a lot of factors, interest rates, profits, all that goes into why the market moves. But one of the biggest influences on the stock market is the economy, how the economy is doing. And, if you watch the news the last year and a half, I mean, we all went through last year, right? Last year was terrible. Market was down 25 to 35%, depending on what you're in. We all got just smacked in the mouth last year. This year, we've had a bit of recovery, especially in, literally, the recovery this year has largely been in only 10 stocks. We talked about them before: the Magnificent Seven, Facebook, Amazon, Netflix, Meta. You can
whoa. Let's not forget, what was it? Marathon Petroleum.
And no. Well, okay. So I'm more talking about the index. So if you look at the S&P,
I was like, whoa.
Yeah, no. I mean, no, there are tons of stocks that are up.
Okay.
Yeah. If you look at the S&P 500 index,
okay,
it's up about 12%. But if you look at the S&P, and that's market cap weighted. If you look at the equal weighted, which means all the stocks have the same weighting through across the board, the S&P 500 is actually down 1 or 2%. So what that means is
let me go back a little bit.
Yeah,
unweighted average means it's based off of the percentage or the size of the holdings in that particular index. The other one means if all things being equal, that is the determining factor for how much weight it has or the influence it has on that particular indice's percentage. So when you hear weighted, not weighted, it's just, I know some of you are like, what are y'all talking about? That's it. It just means if all things were equal, this is what would happen to the percentage.
Yep. And when you hear on the news, and if any place that you hear that they're quoting the S&P 500, they're quoting the market cap weighted. So that's the one you're going to hear. The as Brent said, the equal weight, or all things being equal, nobody quotes that, but they should, because that actually gives a better reading on how stocks are actually doing. So as I was saying, so really the comeback this year has literally been on the top 10 stocks that are in the market cap weighted S&P 500. They've driven the market higher. Everything else in the S&P 500 is basically flat to down. So it's been a bit of a, kind of a topsy-turvy market. So I'll go back to what I was saying before. If you watch the news the last year and a half, you've been hearing about a recession. Recession is coming. It's inevitable. The Fed has raised rates 500 basis points or 5% in the last year and a half, which is the fastest in history. The economy can't handle that. It's going to crash. All these doomsday stories. None of that has happened, right? All the gurus have been exactly wrong. And the kind of reason for that is primarily, so back in 2008, when the market crashed because of the whole housing crisis, I think like 60 to 80% of mortgages then were adjustable or variable rate. So as rates went up and down, your mortgage moved. I think the number now is like 60 to 70% of people that have mortgages have fixed rates. And a lot of them locked those rates in since the financial crisis from 2008 through 2020, 2021. So effectively what that means is most people in this country have fixed rates. So these rates that have shot up aren't really hurting anybody, right? So like people aren't feeling pain because their rate is locked in, versus the financial crisis when rates went up or down or whatever happened then. I mean, everything just got crushed. So so the thought was that the economy would crash based on raising rates. The economy is not as rate sensitive as it used to be. So therefore, the economy is actually holding relatively well. Now I'm gonna go through some quick stats to show you how the economy is actually doing. So when you hear about recession, just kind of weigh it with a grain of salt.
All right, and real quick,
Mhm.
for anybody listening, I know sometimes we throw these stats and we throw words around. We try to do our best to explain them, but we receive your emails and texts. I'm asking, what that mean, or can you tell us more? This is a great time to just ask the questions. If you're listening to the podcast, you can go to iapodcast.com, find this particular podcast, and drop a comment. If you want to drop a comment on our YouTube page, you can go to YouTube, search Investing Education Academy, pull this particular podcast up, and ask a question via the comment section. Essentially, what I'm saying is you all can ask us questions. That's what me and Leon, we are shocked sometimes that we only get so few questions, which is fine with us. But we're trying to be a resource. We're not just trying to make it easy for us. And trust me, between all the things we have going on, getting comments is not easy to respond to. That's why we always say, we'll try our best to respond in a reasonable amount of time, but give us grace. However, we also say ask us questions if you have them, because the other part is our community at this point is big enough, and there's some people in there that are very sophisticated. They may answer the question for you. And again, you never take advice from anybody on the internet who randomly answers or responds to a comment. Even if it's Leon and I, we always say don't follow gurus, don't follow us. Let us serve as a catalyst to help you start your own process to do your own research. Let us serve as a spark to make you think, you know what, I can do a little bit more with my 401k at work. When is the last time I checked it? What is my allocation with my 401k? What's my allocation with my 403b? What's my allocation with my 457 plan? These conversations are designed to make you go, hold up, if the economy's doing this and Leon's about to give you some real stats, maybe I should go check my 401k to see if it's arranged the way that I want it arranged going into the future. But do your research, make sure it's suitable for you. This is not investment advice to any one person. This is not investment advice to everybody. These are just thoughts and facts as we found the research and we're delivering it to you all.
Yep. So we're going to quickly cover some stats regarding the consumer. And as I said, the consumer is us. Everyone in this country, all 330 some odd million of us are consumers. The reason this is important is because the consumer, again, all of us, powers 70% of the United States economy. I'll say that again. The consumer powers 70% of the United States economy. So what we do, what we buy and sell or not do, what we don't buy and what we don't sell, has a huge effect on the economy. So this is why the consumer is very important. Okay, so point number one is there's something called the weekly jobless claims or unemployment filings, and all this is it just reports week to week how many employees were laid off in the economy. Well, last week the unemployment filings came in at 207,000. The estimates that Wall Street expected was 210,000, so that was a beat. Less people were laid off than was expected. That's great. Second point is the big one, right? So the first Friday of every month, the jobs report comes out. This is like the holy grail in on Wall Street. So what was expected was that last month, 170,000 jobs were added to the economy. That was the expectation. Actually, how many were added were 336,000. So more than double the estimates were added. Again, strong economy, right? So what you have is the previous that with the weekly unemployment filing shows that employers are not laying people off in really big numbers, and then the economy added almost double the jobs that were expected. Real quick on the just go back to the unemployment filings. So like I said, it came in at 207,000. So anything around 200,000 or less is considered really, really low for unemployment filings, right? So right now we're at 207. So the economy is shedding very few jobs week to week so far. The number that's considered high is like 250, 300,000 and above that. So we're at 207. So we're really, really low. The economy is not laying people off. the economy last month added more than double the jobs that was expected. And then the third point, this one isn't going to sound as great, but I'm gonna explain why. So, wages last month grew less than expected. Now they grew, but less than expected. So you're probably thinking, well, why is that a good thing if people aren't getting paid, as much as the Wall Street expected? Reason being is this is one of the Federal Reserve's main thing they look at. They do not want to see out of control wages, spiraling upward and upward wages and income for people, because that. So think about it. If you get hired and a company has to pay you 30-40% more than you made your last job, what are they going to do? They're going to then pass that new expense off to the consumer. They're going to raise the price of their product or service. So if the Federal Reserve sees every month to month, that wages are going up by a lot more than expected, they're going to continue to raise interest rates. So the fact that wages they grew, just didn't grow as much as expected. That is actually a dead on number. And
Leon,
mhm.
also too, let me touch on that. So when Jerome Powell is raising interest rates, one of the things he's trying to do is slow the economy, right? And if all of a sudden you get an influx of money at work, what are you going to do? You're going to go start spending.
Spending it, right?
And most people, we love to believe they will just start saving more, but the reality is they start spending more, and all of a sudden spending has a spike. That spike could cause the Fed chair to say, you know what, we need to put greater restrictions in place or raise interest rates again to slow spending. So it's a cause and effect that goes way beyond just the number itself that you hear us reporting. There's this ripple effect of what happens when wages increase. And of course, we want more people to get increases in wages, but in this particular environment where we have a Federal Reserve that is already watching to make sure spending is slowed, you don't really necessarily want to see spending increase because it can cause interest rates to follow.
Yeah, they don't the Federal Reserve doesn't mind seeing wages go up as they did last month, but they came in they grew less than expected, which is good because like I said, they don't want to see out of control wage increases, because again, that's going to drive inflation, because companies are then going to raise the price of their goods and services. So to recap real quick, so the unemployment filings came in at 207, 210 was expected. That's great. Less people were laid off. 336,000 jobs were added last month. The expectation was 170,000 jobs, so more than double the jobs were added. And wages did go up last month, but they went up less than the Fed expected, which is great. So what this looks like, people are calling this the Goldilocks economy right now, right? Because you have low layoffs, high hirings, or people being hired to new jobs, and wages are increasing, but not increasing too much. So this is why. So like I said, over the last year and a half, everyone's been calling for this recession. It has not happened because remember, 70% of the economy is powered by the consumer. The consumer is in awesome shape right now. They all have a job. Well, not they all, but I'm paraphrasing.
Right.
A large portion. So real quick on that. So right now the unemployment rate in this country is 3.8%. 3.8. It is like unheard of. Well, not unheard of. It's very rare that the economy is under 4.5% for an extended period of time. We've been under 4% for I think the last 6 months, 8 months to a year, and like there's no sign of the unemployment rate going above 4%. At one point, the Fed actually wanted to see the unemployment rate rise from 3.5%, 3.8% to above 5%, because that would loosen the labor market and then help bring down wage inflation. So, but it hasn't happened, right? The economy is just strong for whatever reason. And my theory behind it is that another thing you may hear is that all the stimulus money we got during COVID has been spent up, right? It's all gone. Everyone's broke now. Not true. I'm just quickly get wonky. There's a thing out here called M2. The M2 tracks the money in our savings accounts, our checking accounts, our money market accounts, our CDs. It has not really. So we went from 15 trillion in M2, all the money we have, to 22 trillion during COVID, right? So that means we had a 50% raise in money circulating in the economy. 22 trillion was a high. Right now, M2 is only at like 21 and change. So we're nowhere near. It was like 15 pre-COVID, 22 at the high, and now we're at 21 trillion. So right now, we, the consumer, have about $21 trillion in our bank account, just money we can access. right? Versus 15 trillion during COVID. So there's a lot of stimulus money still in the economy, a lot of money for all of us to spend. And remember, we power 70% of the economy. So that's why that's my theory behind why we haven't seen this recession, because the main engine of the economy, which is us, which is the consumer, is essentially still flush with cash. And just real quick to put a number on that. So last year, the economy, the GDP, which is the amount of goods and services created in the economy, in 2002 was 25 trillion. Of that, 17 trillion was produced or influenced by the consumer, by us. So 70% of 25 trillion, that's 17 trillion, was directly influenced by the consumer. So that just shows again how powerful the U.S. consumer is. So just to relate this all back to stocks, as I said, the economy is the biggest influence on the stock market. If the economy were to go into a recession, typically when that happens, the market drops anywhere from 20 to 40%. And everyone's been talking about this recession, this recession. And even last year, when the market was down, say 25%, 30%, the market was anticipating a recession this year. That didn't happen. And that's why we've seen this big recovery in the market right now. So say all this to say, if you hear the doomsayers out there saying recession's coming tomorrow, is it possible? Absolutely. Anything is possible. But the data does not support a recession happening tomorrow, the next couple months, even the next couple quarters. We'll see what happens next year. But as of right now, there's no recession on the in the offing. So that's why Brent and I have been telling everyone, hey, if you can, keep buying stocks, especially on this drop in the market recently. As Brent and I did a podcast, I think we did a podcast, I think it's a podcast.
Yeah, podcast.
Yeah, where we showed the worst months of the worst months in the stock market, which is actually the best time to buy, which is August and September. Over those 2 months, the market was down about 6 to 8% was a pullback over those 2 months. And I know myself, I was doing buying in those months. I was buying some new stocks, and then I was adding some positions that I already had, because again, I saw the opportunity of the pullback. So now we're going into the vaunted Santa Claus rally potentially in December, and usually the market kind of rises into that, and then we get a big spike towards the end of December. Will that happen this year? We don't know. We'll see. But the economy is strong. Like I said, recession is possible. It's always possible, but the data does not support that right now. So if you can, keep investing, profitable companies, growing revenues, growing profits are the two main things. And of course, always do your own research.
So everybody, that'll do it for us. We thank you for being there and being here. And don't forget, for those of you all who are watching us live or you're watching us on YouTube, you can scan our QR code now. We are, trying to be more efficient in the way we do these videos and the way we engage you all. So we want to know, what type of information you want to hear, where your interest lies, and that will be told to us via that QR code. Now, we owe you all two things. I normally forget this, and Leon normally remembers. So I remember this time. We owe you 2 stock picks, which you can find inside of our platform. It's go to ieanow.com, and there it is, ieanow.com. You can become a member, choose whichever membership platform you prefer. If you're already a member, you can just go to iaMembers.com, log in, and most of you all know where to go to find our stock picks. It is a pleasure to have you all with us. We thank you. We're going into our fourth year. Can you believe it? And yeah.
Yeah.
We're about to march into our 4th year. And, we have a lot happening right now, like a lot.
Yeah.
So it's been great. For those of you all who kids have started investing as a result of watching this, that's fantastic. For those of you all who have started having conversations with your kids as a result of this, that's awesome. For those of you all who have just started investing and researching investing as a result of this, we thank you for listening. And for those of you all who have taken this information back to friends and kind of changed the conversations that you have, that you normally might have over a happy hour or tea or coffee, and you're talking more about investing, this is great. I mean, that's why we do this, and we're glad we're having an impact. And that's why we keep showing up to do these lives. Please keep sharing. Again, you can go to YouTube, search Investing Education Academy, subscribe. We're really going to be doing a push in 2024 to get our subscribers up, because Leon and I, we normally do this out of the fact that we care. And so we don't often talk about the fact that we do need to get our subscribers up on YouTube to change the algorithm and how we, go out via that platform. And so we might be asking for your help, during the course of going into the end of the year, going into 2024. And we've been showing up for you all. So hopefully you can show a little support back and go and subscribe. Everybody, again, thank you for your time, and we will see you.
Real quick, just want to say again, if you want the audio version, it's IEApodcast.com. I know a lot of people want to go with that. So IEApodcast.com is the audio version.
There you go. Everybody, have a great day.